For a century, the financial world has moved in cycles so eerily predictable that historians often mistake coincidence for destiny. Yet those who study the deepest layers of market behavior know the truth. Every major collapse, 1929, 1987, 2008, and now the unfolding storm of 2025 follows the same hidden blueprint. Picture this: in 1929, a battle-hardened trader stands in a crowded Manhattan brokerage house quietly selling while ordinary citizens mortgage their futures to buy stocks. In 1987, a young manager watches computer-driven program trades distort markets into something neither human nor stable. In 2008, a handful of contrarians sit isolated in their offices reading mortgage data no one else bothers to analyze. And today in 2025, tech founders and corporate insiders unload billions of dollars in shares, while the public screams that artificial intelligence has abolished economic gravity. 4 eras, 4 worlds, 4 crises, and beneath all of them the same 3 movements unfold like clockwork. Long before the headlines, before the panic, before the forced liquidations and the televised chaos, a select group of investors make what history now calls the 3 escape trades. Not complicated strategies, not secret Wall Street wizardry, just 3 deliberate actions taken months, sometimes years, before the masses even suspect danger. These trades are the dividing line between those who survive and even grow richer during catastrophe and those who watch everything collapse in front of them. This video reveals the full architecture behind those decisions. We will break down the 3 escape trades, show how they operated across 4 historic crashes, and examine why the same signals are flashing again right now in real time across the global financial system. What you must understand before anything else is this: market crashes are not random storms. They are mechanical events born from leverage, magnified by human emotion, and accelerated by systemic design flaws that have never been fixed. Because the machine has not changed, the blueprint of collapse has not changed either. And the moment you can see that blueprint, the moment you recognize the same setup forming, you no longer fear the crash. You anticipate it. You prepare for it. You position ahead of it. The only question now is whether you will act on that pattern or ignore it the way most people always have. The blueprint is visible. The signals are active. And the 3 escape trades are appearing once again. If every crisis unfolds through a mechanical sequence, then every path to survival must be designed to counter that sequence. This is why the 3 escape trades are not theories, not philosophies, and not lucky guesses. They are structural responses to the architecture of market collapse. The first is the exit to cash, the moment when smart money quietly steps away from the table while the crowd is still celebrating. Cash is not glamorous, it does not impress anyone at cocktail parties, and it certainly does not rise during a manic bull market. But cash serves a deeper purpose. It buys you the one asset that disappears first during a crash time. When leverage unwinds, when margin calls hit, when forced selling triggers, forced selling, those holding risky assets are dragged into liquidation, whether they want it or not. Cash stands outside that death spiral, untouched, unforced, waiting patiently for opportunity. The second is the shift to hard money, most commonly gold. Crashes do not end when markets hit bottom. They end after governments respond. And governments always respond the same way. They slash rates, inject liquidity, expand balance sheets, and devalue the currency to stabilize the system. Fiat money loses purchasing power, and the printed rescue becomes a quiet tax on everyone holding cash. Gold, however, does not care about interest rates, politics, or central bank speeches. It is the form of money that outlasts empires, resets devaluations, and broken promises. In every crisis, gold is the bridge that preserves purchasing power until the storm calms. The third is positioning for volatility. the most misunderstood yet most powerful trade. Market crashes do not decline gracefully, they collapse violently. Volatility spikes, liquidity evaporates, and prices gap down faster than human reflexes. But for those who hold instruments designed to profit from chaos, put options. Volatility futures credit insurance. This phase becomes the moment of maximum opportunity. While the world panics, these instruments surge in value precisely because fear becomes the dominant force in the market. These three trades work because they align perfectly with the 6 immutable stages of collapse the bubble, when prices detach from fundamentals, the euphoria when narratives overpower math, the leverage phase when everyone borrows to chase illusionary gains, the trigger the spark that exposes the system's fragility, the forced liquidation when margin calls cascade, and finally the panic when humans realize too late what the machines already knew. Cash protects before forced liquidation. Gold protects after governments flood the system with printed money. Volatility profits during the violent heart of the collapse itself. That is why the 3 escape trades appear before every major crash. They are the only set of moves that counter the physics of financial destruction. Every great escape from a market collapse begins with the same almost invisible decision, the quiet, disciplined, unemotional conversion to cash. Not a dramatic liquidation, not a panicked sell-off. A slow, calculated retreat made while the crowd is still convinced the party will never end. In the late 1920s, one seasoned market operator understood this better than anyone. While America was intoxicated by the illusion of endless prosperity, he studied the margin structure beneath the surface. He saw ordinary workers borrowing 90% of a stock's value just to buy more of it. He saw a market rising not because of productivity, but because of credit expansion. So he began selling methodically, patiently, quietly. As shoeshine boys gave stock tips and newspapers declared a new permanent era, he was doing the one thing the public could not imagine walking away. When the crash arrived and the market collapsed nearly 90%, he sat on a mountain of cash untouched by the destruction. Decades later, in 1987, a young money manager saw echoes of the same pattern. The Dow had more than doubled. In a handful of years, valuations stretched, and program trading created artificial feedback loops that pushed prices far beyond their fundamental support. While investors celebrated their paper wealth, he studied the mathematics of automated selling and realized the entire structure could collapse in a single day. And so once again, smart money exited. He reduced long exposure, raised cash, and positioned himself outside the blast radius. 17 days after the market peaked, the worst single-day crash in history hit. Those clinging to the bull market lost fortunes in hours. Those who had quietly raised cash were protected. In the mid-2000s, the pattern resurfaced. A contrarian fund manager studying housing data realized the mortgage boom was built on sand-fraudulent lending standards, exploding leverage banks, hiding risk inside opaque derivatives. He stopped buying stocks altogether. He raised cash. He braced for the collapse no one else believed possible. Another legendary investor, known for patience and discipline, spent years doing nothing but accumulating cash because nothing in the market met his standards of value. People mocked him for being out of touch. In 2008, the world learned who had been right, and now in 2025, the most unmistakable signal of all has appeared again. Corporate insiders across America, CEOs, CFOs, founders, tech leaders are selling their own shares at a scale not seen since the months before the 2008 collapse. The largest holding company on earth sits on a cash pile so massive it dwarfs every other corporate balance sheet in history. Its leader publicly states he cannot find a single major asset that is attractively priced. That is not a casual remark. That is a warning. Meanwhile, some of the wealthiest individuals in technology and finance have quietly sold billions of dollars of stock while insisting publicly that the future is brighter than ever. When the people who see the real data, who sit closest to the economic engine, who understand the internal numbers better than any analyst, when those people begin raising cash, the pattern is repeating. Trade one is never loud. It is never emotional. It is never impulsive. It is the calm before the storm, the preparation phase, the moment where smart money steps off the accelerating train just before it derails. And like every time before, it is happening again. If trade one is about stepping away from danger, trade two is about protecting the very essence of your wealth from what comes after the crash. Because every collapse ends the same way, not with silence, but with printing presses roaring to life. Governments slash interest rates, flood markets with liquidity, and expand their balance sheets to stop the bleeding. What most people fail to understand is that these rescue packages are not free. They are paid for through the quiet, invisible erosion of the currency itself. The dollars in your bank account may still be there, but their purchasing power is not. And this is why those who understand the rhythm of crises always convert a portion of their capital into hard money, most commonly gold, before the storm arrives. During the early 1930s, as the Great Depression deepened, one astute investor recognized that deflation would not be the final chapter. The real threat would come afterward, when policymakers desperate to revive the economy would weaken the dollar. So he shifted into gold. When the government eventually revalued gold from its old fixed price to a dramatically higher one, his purchasing power surged even as the broader economy remained shattered. In 1987, even though the crash unfolded in a single violent day, the logic held. Investors who had positioned into gold beforehand watched it rise as the world scrambled for safety. The gains were temporary, but the lesson endured. In moments of fear, capital instinctively moves toward hard assets. In the 2008 crisis, the pattern became unmistakable. As banks collapsed, as credit markets froze, as central banks launched unprecedented rescue programs, gold surged from roughly $600 an ounce to over $1,000 and then kept climbing for years. Those who had quietly accumulated gold during the calm years before the crisis saw their purchasing power preserved and in many cases multiplied, while the value of fiat currencies eroded under the weight of money creation. And now in the 2020s, the most powerful version of Trade 2 is unfolding in plain sight. For 3 consecutive years, central banks around the world have been buying gold at levels not seen in modern history. China, India, Turkey, Poland, Singapore, nations that rarely move in unison, are shifting reserves from paper assets into metal. They are voting with their actions, signaling a loss of faith in long-term fiat stability. Billionaires and hedge fund managers echo the same logic. Some disclose gold as a core hedge against inflation instability or currency debasement. Others hint at it quietly, with portfolio allocations that speak louder than their interviews. Gold does not rise because of hype. Gold rises because confidence falls. It rises when the global financial architecture weakens. It rises when debt becomes unsustainable. It rises when money printing becomes the default tool of policymakers. Trade 2 is not designed to make you rich. It is designed to ensure that when everyone else grows poorer through currency devaluation, you do not. It is the transfer of wealth from paper promises to a form of money that cannot be printed, erased, or inflated away. It is not loud. It is not flashy. But in every crisis, it becomes the anchor that keeps wealth alive while the financial world resets around it. If Trade 1 protects you and Trade 2 preserves you, Trade 3 is the only one designed to make you wealthier. Precisely when the rest of the world is breaking. It is the trade most people never execute, not because it is complicated, but because it requires psychological inversion, the willingness to prepare for chaos while everyone else prepares for more prosperity. Market crashes are not gentle declines. They are violent, disorderly, mechanical implosions, where selling begets more selling and fear feeds on itself. This is why volatility, usually ignored in quiet markets, becomes the most explosive force in finance during a collapse. And it is why those who position for volatility before the panic begins often earn what looks like impossible profits. Nearly a century ago, in the months before the 1929 crash, one trader began shorting the most overextended stocks in the market. His timing was not perfect. Prices continued rising, borrowing fees ate into his capital, and the world insisted he was wrong. But he understood the mathematics of leverage. When credit fueled the boom, it would also fuel the destruction. When the crash hit, stocks fell, not in days, but in cascades, and his short positions transformed from painful expenses into life-changing profits. Decades later, in 1987, the same logic returned in a new form. A young manager recognized how program trading and portfolio insurance could turn a minor decline into a self-reinforcing spiral. He bought put options, contracts that grow more valuable as markets fall, even as his peers mocked the idea of a crash. When Black Monday arrived, volatility exploded, indexes plunged more than 20% in a single day, and his puts skyrocketed so violently that he made in hours what funds normally made in years. In 2008, the physics of volatility reached their most powerful expression. A small group of contrarians bought insurance on mortgage-backed securities through credit default swaps. Month after month, they watched their premiums evaporate, ridiculed for betting against the safest market in America. But when the truth surfaced and defaults spread, their positions did what almost no trade in history had done: turned a few $1 million of annual premiums into billions of dollars of profit. They had positioned correctly for volatility long before volatility arrived. And now, once again in 2025, the unmistakable signs of Trade 3 are visible to anyone who knows where to look. Credit insurance on commercial real estate has surged pricing in a wave of defaults from empty office towers and impossible refinancing math. Institutions are quietly buying long-dated put options on major stock indexes, not to gamble, but to hedge against the very real possibility of a structural decline. Volatility products ignored during the AI-fueled optimism are seeing abnormal activity months before any crisis has officially begun. The pattern repeats because the mechanics repeat. When leverage saturates the system, when prices drift far from fundamentals, when sentiment becomes delusional, the smallest shock can ignite a chain reaction. And that is when volatility ceases to be a footnote and becomes the main character. Trade 3 is not for everyone. It demands discipline, patience, and the acceptance that premiums may decay for months before the payoff arrives. But when executed correctly, it turns the most feared phase of the cycle, the collapse, into a moment of extraordinary opportunity. While the crowd panics, the prepared collect. While others lose everything, the few who understood the pattern transform crisis into profit. Trade 3 is the final strike in the trilogy of protection, preservation, and profit, the trade that completes the blueprint of escape. Every generation believes its crisis will be different, its markets more sophisticated, its technology more advanced, its policymakers more capable. Yet every generation learns the same brutal lesson. The mechanics of a crash do not evolve because human behavior and leverage structures do not evolve. Bubbles are born the same way prices drifting upward faster than fundamentals, pushed by optimism, storytelling, and the illusion that a new era has begun. Euphoria always follows a psychological fever in which caution is ridiculed and risk is glorified. Then comes leverage, the accelerant poured onto dry grass. Borrowed money, margin, accounts, corporate debt, speculative derivatives. Everyone stretches a little further because the system rewards recklessness during the boom. Next arrives the trigger. It can be anything: a bank failure, a missed earnings report, a geopolitical shock, a rise in interest rates, an unexpected default. The trigger does not need to be catastrophic on its own. It only needs to expose the fragility of a system already stretched to the breaking point. Once the first crack forms, the machine takes over. Forced liquidation begins. Margin calls slam into over-leveraged investors. Funds sell, not because they want to, but because they must. That selling pushes prices lower, which triggers more margin calls, which forces more selling in a self-feeding loop with no regard for fundamentals. Within days or weeks, markets enter the panic phase where rationality evaporates and survival instincts dominate. Investors dump assets at any price, liquidity disappears, spreads widen, volatility spikes, and the entire financial world begins to feel unmoored. In this mechanical collapse, fundamentals do not matter. Balance sheets do not matter. Opinions do not matter. The only things that matter are liquidity leverage and the unforgiving arithmetic of forced selling. And this is precisely why the 3 escape trades work. Trade 1 keeps you out of the blast zone before forced selling begins. Trade 2 preserves your purchasing power when policymakers respond with a tidal wave of printed money. Trade 3 converts the violence of volatility into profit using the very panic-destroying others to propel your positions upward. Crashes feel mysterious only to those who never studied their structure. To those who understand the machinery beneath the surface, crashes are simply the same movie played with different actors. The plot never changes. Only the audience does. Right now, in 2025, we are not witnessing random noise or temporary volatility. We are standing inside the late stages of a familiar sequence. Valuations have reached levels that no historical model can justify. Debt has climbed to heights that no repayment schedule can sustain. And investor sentiment has entered a phase where storytelling matters more than earnings cash flow or basic arithmetic. The world believes artificial intelligence will rewrite economic law, erase risk, and create infinite growth. But every bubble in history has disguised itself as a revolution, and every revolution has eventually collided with the limits of leverage and liquidity. The signs that smart money is positioning for the next phase are everywhere. Corporate insiders are selling at a scale last seen before the 2008 collapse. Cash positions among major institutions have surged. Governments around the world are rolling over debt at higher and higher interest rates, testing the structural limits of their fiscal engines. Meanwhile, the quiet migration into hard assets continues, central banks buying gold at record speed, wealthy investors shifting toward tangible stores of value, and sovereign nations reassessing their exposure to a debt-heavy, dollar-dominated financial system. Even volatility markets whisper the same warning. Long-dated puts, credit insurance, and structural hedges are appearing months before any official crisis is declared. You do not need to be a billionaire or a hedge fund manager to follow the blueprint. You only need to understand the simplified version of the 3 escape trades. First, raise cash not by selling everything, but by reducing exposure to overvalued, highly leveraged, or speculative assets. Even moving from 70% invested to 40 or 50% gives you the breathing room that most investors lack when panic arrives. Cash is not an opinion about the market. It is a shield against forced liquidation and a future weapon for buying opportunities. Second, convert a portion of your capital into hard money. Gold, high-quality stores of value or assets that cannot be diluted by policy decisions. 5 to 10% is enough to protect purchasing power when central banks turn to their only tool, printing. Third, buy protection, not as a gamble, but as insurance. A small allocation to long-dated put options or defensive hedges can transform a market collapse from a threat into an opportunity. These are not heroic trades. They are not aggressive trades. They are protective trades, moves designed to ensure that When the cycle turns, you are not trapped inside the machine. And perhaps most importantly, prepare psychologically. Crashes do not reward the smartest investors, they reward the calmest. When markets fall 40 or 50%, when headlines scream disaster, when friends panic and portfolios bleed red, only those who prepared in advance will have the clarity to act. Build your watch list now. Know what you want to buy when fear reaches its peak, because when the moment arrives, hesitation becomes as costly as ignorance. The blueprint is not a mystery. It is simply a roadmap that most people refuse to follow until it is far too late. When a crash finally reaches its darkest point, when markets are suffocating under forced liquidation and optimism has vanished, only one opportunity remains: the fourth trade buying the ruins. Every major crisis drives prices far below their true value, not because businesses fail, but because fear overwhelms logic. Strong companies trade at the same discounts as weak ones. Real estate collapses under distressed selling, and entire sectors are abandoned simply because investors cannot endure more pain. At that moment, those who executed the 3 escape trades stand in a position of rare power. They hold cash untouched by the crash purchasing power, protected by hard money and profits won from volatility. They are not trapped. They are prepared. And as history shows, those who deploy capital into fear calmly, methodically, decisively emerge, not just recovered, but transformed. The fourth trade is where crises turn into fortune. The pattern is clear, the sequence undeniable, and the signals are repeating once again. Some people will ignore them, trusting hope over history. Others will recognize the blueprint for what it is: a roadmap that has predicted every major collapse for a century. Those who raise cash, hold hard assets, and position for volatility will not just survive the next downturn. They will shape what comes after it. And when the bottom arrives, they will seize the moment others fear. The choice is simple: deny the pattern or act on it. Only one path leads to strength when the cycle resets.